You're about to join Jerry Parker, Moritz Seibert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Seibert, and I, Niels Kostrup-Larsen, are delighted to be back with this week's edition of the Systematic Investor series. And as usual, we're going to discuss last week's events in the world of rule-based investing and take some of your questions. Good morning, Jerry, and good afternoon to you, Moritz. How are you?
Great. Hi, Niels.
Great.
End of another week, first week of December. Doesn't disappoint. Lots of volatility in many markets, it would seem. News flows also pouring in, even though it should be dying down a little bit as we enter the holiday season, but it certainly hasn't done so. So why don't we just jump right into it and talk about some of the things that happened in our portfolios and to see how we reacted to all of this volatility. So can I, as usual, start with you, Moritz, and just see how things were happening in your world of trend following?
Sure you can. Happy to give you some summary there. Actually, a positive week for me, between 1.5% and 2% up.
Great.
Most of that coming from long bond positions in Germany and Japan. Lost some money on US bonds, but nevertheless, it's been a volatile week because Monday came in strong as far as the equities are concerned on the back of the alleged agreement between the US and China on trade, which then wasn't really that clear. So, markets fell again on the Tuesday. Currencies were mixed, losing on the Monday and then gaining for the rest of the week, I think. Commodities, energies, lost a bit of money. So I have to say, really, the P&L was driven by the bond markets this week.
Yeah, no, absolutely. I would say the same on our side, but unfortunately not quite as successful as you, Moritz, this week. Strong gains in short equity positions, unfortunately offset by short positions in US fixed income, which were bigger than long positions in European fixed income. So that outweighed to some extent or at least neutralized the gains in short equity positions, and then a bit of losses in currencies and in some of the commodities. So a slight negative start to the month of December, which of course, seems to be wrapping up as one of the more difficult years we've had as an industry for a while, but maybe we'll come to that shortly. Jerry, what was your week like from what you're seeing?
Probably in third place, it sounds like, in performance this week.
Okay.
Not a lot happening as currencies were pretty good, I guess, towards the end, and then rallies in a lot of the short positions in commodities. Not crazy rallies, but still long a few U.S. equities, and amazed by the relentless selling whenever there's a rally. So the price action is telling us to beware. I don't know if the shorts will be good. Don't know how much how much of a downtrend we'll see in any of the stocks, but pretty confident that the long positions for a lot of stocks look very shaky.
Yeah. I mean, you mentioned something about the selling into these rallies in equities, and I think the three of us touched base during the week, and one of us had come across an article about this quote-unquote expert at one of the big investment banks who were trying to follow the signals of people like ourselves and then kind of try and trade against that, or at least publicly saying, but this sell-off is due to the CTAs and trend followers, and they're the ones to blame. But as you talk about things being sold into a rally, that we can say categorically it would never be a CTA. I mean, we don't sell into rallies. That's just not what we do. So I think his comments were, obviously creating good headlines, but I'm not so sure it's accurate in that sense. Did you pick up anything on those topics during the week?
Well, a lot of CTAs will sell the rally to if the portfolio volatility requires it,
Yes,
which is somewhat
yeah.
of a welcoming, I guess. They buy the breaks as well, and so that is better of vol targeting than going with the trend, I think. But I think it's a very good example of our brains wanting to discount the price action. Well, you can ignore this price action because it's just the CTAs. I do it. Everyone does it. It doesn't manifest itself in my trades, but I definitely think about it. Is this a legitimate rally? I was questioning the sell-off in crude a couple of weeks ago or a month ago, and then maybe it's just a fake rally. It's a lot of extreme selling, and now no. And so I don't think that's ever healthy to sort of say we can ignore this particular price movement because I can blame it on a source that may not truly be reflective of the fundamentals. So we don't ever want to get in that situation.
But it's also, I think, some of these headlines. It's about blaming others than maybe some of their own. All of these investment banks, they have their own quantitative approaches, and they have their own flows and their own views. And does it mean that if they come out with a recommendation and things and people buy or sell based on that recommendation, that there's anything wrong with that? And of course we would say there's not. But every time there's something that seems to happen that especially on the downside, rarely do we get praise as an industry for markets moving higher. But every time there's this sort of volatility increase and pressure on equities, despite the fact they've gone up for 300% in 10 years, as soon as they lose 2 or 3% in a kind of hectic day, you need to find a scapegoat, and I think it's just a crazy thing happening. But anyways, what else happened in sort of in your anything interesting in your portfolios? We certainly continue to see reduction in short fixed income positions based on this rally and turning around on in that sector during the week.
Stable portfolio on my end, so no changes there.
Okay, cool. Anything happen, by the way, single stocks? Anything exciting happening in the single stocks world that you noticed, Jerry?
Not a lot. Some days the McDonald's, Walmart's, Coke, Pepsi rally, and then some days they just go down like the whole market. So I think my portfolio is very diverse. I have longs and shorts and flat positions. When tech goes down, I may be buying Coke and Pepsi. So that's good to see. But on some of those Friday, I think every stock is down. So
Right.
That's not getting much diversification on those days.
No. Well, let's see what happened in social media land during the week and see what people liked and maybe didn't like so much in terms of the top tweets. How did that look? Where did you get some good reactions?
Quiet week on the Twitter front. Unfortunately, the most popular tweet was one that quoted an article about the SocGen Trend Index, saying that the 10 largest trend followers are down almost 10% for the year, which would be the worst performance on record since 2011, when the SocGen Trend Index lost 8%. One of the CTAs quoted in the article, I guess, is a little had it with 2018, ready to move on to 19, and their response was the outlook is bewilderingly complex and hostile. So I just thought that was maybe, a reflection of our emotions, and we get going, and we certainly can feel like that the market's out to get me. Things are very hostile around me because I keep losing money. I know I keep feeling that way, and it's probably best just to stick to our systems. And I get around complexity and being bewildered by following prices and following my system. So trend following offers that opportunity to ignore how complex and hostile things might be. I went and looked at some long-term trends over the earlier this morning to see what the trends look like over the past 10 years and looked at almost every market in a 10-year chart. And one of the things that stood out was some very poor periods of trend and lack of trends, and that pretty much just set up other periods where we had really nice moves. So it's never right to get too pessimistic or optimistic.
No, I mean, I think the headlines, and I know I've mentioned this before in our conversations. I mean, I think the headlines and the type of performance we're experiencing at the moment really reminds me about sort of 2013, right before a great 2014, and also 2007. The summer of 2007 was pretty tough, right before things really got going again. And it's, it is so hard because we can't help looking at our positions and thinking, okay, so how is this actually going to play out and suddenly turn into, a great period of time for trend followers? And you try and put in your own thoughts about, well, what if they do this with interest rates and so on and so forth, and that's not going to help, or so and so. But it's so that is the challenge. The challenge is not to do all of that and then just trust the process as it has worked for decades, and not try to predict anything as such. But I'm sure the headlines would have been pretty much the same back then, prior to these great periods. And I still think, I know we've quoted a little bit maybe from it, but Longboard, one of our peers in the trend following space, they put out a great piece. Cole Wilcox put out a great piece about his thoughts on managed futures, and there's some pretty interesting charts that makes you think that this is not as bad as it may seem, and there's going to be lots of opportunity going forward for this industry to have a roaring comeback.
That's right. I mean, prior to 2008, who was standing up and saying, it's very risky to have a portfolio that's dominated by long equities? No one, so in good times, we need to remember good times for equities or a certain strategy we may not agree with. We need to remember that we do have a much safer strategy with longs and shorts and systematic approach and taking small losses. And the value that we see in it is different than the value that others see, because the recent performance has not been great. But we need to get ready for a different environment, and we'll show we have a lot to offer.
Yeah, absolutely. Are you coming across this issue, Moritz, on your side?
Sure, I think everyone does. But look, I think the markets, they're tricking us, so we're ourselves are tricking us a bit here. It's only really the last 2 months and February this year that have been on our radar screens, and we remember them because we live in the right here now, and we every day we see those markets. But when I step back looking at my portfolio, I've certainly been in much more worse situations. And so, I go, okay, well, that's one of those episodes. It may even get a lot worse from here for me. But at the end of the day, let's wait for that smoke to clear. There will be better times coming up. So that is what I do. I try not to get too involved or downbeat by it. I know it's very difficult, but I kind of like force myself to be that way. This has just been, one of those weeks, one of those months, maybe a quarter that's down. Okay, fine. But, doing this for years, always come back up on top at some point.
Absolutely.
The power of following a system and doing every trade that you're supposed to do.
Yeah.
That's what's going to get you out of all the situations. And we're in a situation of lack of performance that has nothing to do with not following the system. So it is, that's what we're required to do. And it doesn't matter how we feel. And in looking at those 10 years worth of charts and all the different markets, if I looked at 2013 and saw some sketchy performance and some lack of trends. And someone said, well, how did you feel in 13? I said, I have no idea how I felt. 14 was so awesome that got out of I didn't remember any of 13 once 14 got going. And that's how we'll feel pretty soon, I'm sure.
Yeah, I mean, speaking about that, I mean, obviously we launched this podcast series at a very interesting time, just before it really got tough again this year. And so it will be interesting for us to revisit these conversations, hopefully in the not too distant future, after we've had an amazing run, and we'll see if the listeners feel that our mood is a little bit different when we've had a couple of months of very strong performance after, instead of this period. But anyways, I hope people listening to us will take some comfort away that this is not the first time we've seen it. It won't be the last time either. So just stay the course in terms of that.
Exactly.
Yeah. What else happened in the tweet world, Jerry? And also, Moritz, if you saw some other tweets or other posts that you think was interesting, let's bring it up.
Well, like I said, it was very slow. Maybe I was traveling a lot, and my creativity and my ability to find interesting things was not at its peak this week. Sometimes I sit around late at night, and unfortunately, I'll have a glass of wine, and I get very prolific. I think I am at the time, anyways. And so one of the ideas that I just felt like tweeting was kind of a thing I mention all the time, and I can't get off of it, which is this idea that a trade doesn't need risk management beyond the stop loss. And money management or portfolio trades kind of reduce the robustness and really are the definition of not following the system. So that's my extreme point of view, and that's how I trade, and it's not the majority opinion. But I got a few people going, I guess. I think it's difficult to get that entire concept across on Twitter. And there are situations where risk management and portfolio adjustment trades are definitely necessary. But I think by and large, if you have your leverage correct and your diversification correct and a pretty decent trend following system in place, one has to look hard at doing a kind of what I would consider to be sort of a non-system trade. Our systems are sort of created and have the strength based upon the sample size and we're able to count these trades, the entry, exit, count them and get thousands of trades. And altering that somewhat is something I'm just dead set against. I'd rather trade smaller if I have to frequently go in and alter my trades based upon the volatility in my portfolio because I can't sleep at night. Personally, I would just trade smaller so I can not be forced to do a lot of the portfolio adjustment trades, certainly not on a daily basis, but once in a while, yeah, it's definitely something I would consider.
But I think it's interesting, right? Because in a sense, we know there are, as you say, I mean, there's no wrong or right. It's a personal choice, and it works for you and has worked for decades, right? But I think the great thing is that other people may have different approaches to it, and they can make it work for them. So, what is the commonality between those things? What is it that really makes these things work? It's the discipline. It's the fact that we do have rules, the fact that we follow the rules, et cetera, et cetera. So whether the rules are a little bit different is not so much the point in my view, but it's the fact that you do have a set of rules that you have tested and you're comfortable with and that you decide to follow, at all times.
Well, by the mere fact that I kind of keep bringing it up and I can't really control myself, I do think that, to me, I don't agree with what you said. So obviously, to me, I think it makes a difference. But I have said that I am always amazed at, and this is not the only thing that I feel the need to stake out a somewhat contrary opinion on. And I'm always, single stocks, you must trade single stocks. And so there's these different things that I really think are important. And I read about other managers and talk to other CTAs, and they're like, no, I don't agree with that. And so it's kind of funny that it doesn't look like my performance is any better than anybody else's or, consistently better So I do wonder, like, okay, I have these opinions, but I guess it doesn't matter a great deal. And I think that the reason it doesn't is because these trends are so powerful. And even if I have it slightly wrong or someone else has it slightly wrong on these nuances, let's say, we're all diversified, we're taking longs and shorts, and we're going with the trend. And, when you sit back and make a lot of money in a big trend, and just the most important thing you can do is not do anything. Just let it follow your system, let it go, sit through some maybe uncomfortable movement against the trend, only to see it continue. And so that is what kind of takes over and overwhelms all of us because we're not perfect. Our systems are not perfect, that we just can ride these trends. And I think, thankfully, I'm thankful for that.
Yeah, no, absolutely. And there's nothing wrong with, sticking up for whatever views we have. I mean, that's great, in my opinion. Any other things from the tweet side, Jerry? We don't have a lot of questions this week, but so anything you've seen in the social media world would be interesting to bring up, talk about. Or you, Moritz, of course.
I was traveling for most of the week, so didn't follow it that closely.
Sure.
Last week, there was a tweet that we didn't talk about, and it was a quote from Bogle from Vanguard, and he was expressing some concern about indexing and the popularity of stock indexing, and maybe if it got too large, it would not be a good thing. And I tweeted that, and it was just amazing how the intensity got so high amongst some of the replies to that tweet. And obviously they were arguing against their, the creator,
right,
and saying, no, he's wrong. And so I could see myself doing the same thing if one of my mentors said, trend following is not it's not good anymore. I would definitely argue with that concept. So I kind of found that kind of interesting, that there's no tolerance for getting away from the company line of indexing is just wonderful and amazing, and this big shortcut to riches. But then this week, I also got another quote from the Wall Street Journal about market cap weighted index funds that they cause investors to accumulate in the largest, most momentum-driven names, doing nothing to diversify the concentration of related risk. In down markets, the potential damage from overconcentration can be extreme. And I think, that's one of the things we keep saying, diversify into currencies, commodities, bonds, and shorts. But we don't even, I didn't even think about, just from, if your options are only going to be stocks, then there's not a lot of diversification in the S&P or the cap weighted indexes. Not like my portfolio of single stocks that I have some shorts and some longs and some flats and different, all the different industries and sub-industries are represented. So it is even worse than I kind of think about being just wanting to be in cap weighted indexes.
I mean, but it's an interesting point, right? Because I think I saw that point you mentioned about the index funds and the in the interview I think he had made with Wall Street Journal, where he's basically saying, I think something along the lines that with the growth of these index funds, the voting power within companies, within the biggest companies in the US, it's already now a large percentage of the overall votes are sitting with these index funds, and in 10 years time or whatever the number was, it's going to be such a big number that it's a problem in his opinion, which of course goes against to the industry that he created. But it's almost like so I think a lot of the conversation in the news is about crowded trades being, is there too much money in trend following? And I think that's going to be also related to a question from one of our listeners. So we hear about that, but it's rare. And it's kind of funny that it's the inventor of the index funds himself coming out with this point and saying, well, hang on, guys, is our industry getting too big? Or are there some unintended consequences from the popularity of people just buying the passive funds? So I thought it was a good discussion. I hope it gets a lot more attention, because I do think it's a big problem for the real economy, that you have so much of the voting rights sitting with financial investors, which at the end of the day will probably be only a handful of firms that will, be able to have massive control on corporate America.
Which I like to believe is a solvable problem, right? Because why cannot, if you own a couple of shares of an ETF, why can you not get the associated voting rights with the stocks included there, and you vote through a proxy?
Yeah.
So there must be some, or at some point maybe there's a technology or a software or something like that makes it possible for ETF holders to
exercise their right
to have a vote. Yeah, exactly.
Yeah, that's a good point. Anything else, Jerry, you want to bring up from the Twitter world, or?
I don't think so.
Okay.
I think that's about the extent of it.
And by the way, I think since we're approaching the end of the year, which also means we're approaching the beginning of 2019, where a lot of the big conferences are happening in Miami in early January, mid to late January. So maybe there should be like the systematic investor meetup. Maybe we should encourage people to meet up at these events if they're listening to these podcasts and they want to hang out. Just an idea, throwing it out there. So anyways, one of the listeners, Vincent wrote into us, and there's a short version and a long version. I'm going to stick with the short version. And his question goes a little bit related to what we talked about earlier. Do you really believe that the total amount of trend following money is enough to impact the trends themselves, given the difficulty of enduring drawdowns? Is there an estimate of the total amount of money invested in trend following? Who wants to go into that one first?
I'd love to know that myself. And as far as the estimate goes, I mean, we have the AUM of the larger CTA industry that are reported.
Sure.
With Bridgewater, without Bridgewater.
Yeah.
But then, those are the AUM. It doesn't include anything about, it doesn't, there's no link to the notional exposure that we're trading as an industry.
And it doesn't include people like yourself, actually, Moritz.
And it doesn't include internalized traders and another trend follower. So extremely hard to even come up with a rough guesstimate on that. I kind of given up.
Yeah. But is there too much money? Just to finalize, do you think there's too much, whatever the number is?
I don't know that. I don't know that either. And I don't want to judge just by looking at a couple of years of past performance and say that because those, say, past 2-3 years haven't been that great compared to the historical averages, that must be because there's too much money chasing the same trends, right? Sure. I mean, if everybody tried to get in and out at exactly the same point in time, then that would have a negative consequence. And, kind of like those trends would be influenced. We'd be influencing ourselves. Maybe things become a bit more erratic, but then, I don't think that everybody is necessarily going to trade at exactly the same point in time. We're using different systems. Yes, over long periods, we kind of like do the same thing, but we're not exactly hitting the same price point. And there's also, certainly larger traders that, trade throughout the day, and they're not looking to target and get done on the settlement. They VWAP or TWAP or use algos, trade throughout the day, which is, a point in time where certainly I'm not trading, or normally I'm not trading. So I really don't know.
No, fair enough. Any thoughts on your side, Jerry, on this topic?
It's a complex subject. I'm sure in some trades and some points in time there, we walk all over ourselves and we hurt each other by everyone trying to get in or out at the same time. Hard to say the impact. I think it would probably be easier to measure in a good period where we can all participate in a long-term trend and see how hard it was to get out of that nice profit and what happens at the very end. One of the reasons I want to be long-term, super long-term, is to stay out of everyone's way and acknowledge that since there are a lot of people looking at trends, trying to find the exit points of everyone, just to sort of stay out of that and make it very difficult to get knocked out of a long-term trend. But the concept of more trend following, is that going to hurt trend following? I absolutely think that's true. Do we have too much now? Not sure.
No. I mean, I think there's obviously a lot more money that what the numbers show from the internalized trend following methodologies that we see both in insurance companies, pension funds, and other institutional investors. I do think where there could be, I mean, my main concern about this is not that there is too much money overall. I think we all trade very liquid markets, and I don't think that that's gonna, that it hurts us. But for those products who have been developed as very simple trend replicators sold for next to nothing, I do think that they use more similar techniques and different techniques to what the three of us use. And I think in those kind of strategies where a lot of these products have collected a lot of money in the last few years, if they are similar in style, then of course also their entries and exits will be similar. And in those situations, you could potentially see some more slippage if you're trying to trade like they do. Other than that, I don't think there's any real concern. And I don't think that performance this year or a single year or 2 years of below par performance from CTAs has anything to do whether there's too much money or not in the space. I mean, it has to do with whether or not there's enough trends around, and we know from history that not always do we have enough trends to have a good year, and that will continue to be that way, in my opinion. Well, we think. Oh, well, actually, before I go with Vincent, Vincent has one more question, and he just says, "What sources or methods to turn to in order to maintain conviction and discipline in the face of persistent drawdowns?" And of course, this is a topic we've discussed probably in every single episode we've done. I mean, how do you stay true to your strategy and your discipline during the difficult times? And certainly it seems to be a question that a lot of people find to be important and difficult to deal with themselves. So just for the sake of maybe repeating some of the things we've said, if I could turn to you, Jerry, first, just maybe some of the things that gives you the confidence that you have and allows you not to get too emotionally attached to the performance numbers. Are there anything you can share with Vincent on that?
Well, just without being able to prepare a great answer, what I thought of was two things. I know what I want to accomplish, and I build my system to try to accomplish staying and participating in long-term trends and not getting bounced out too quickly, but not giving too much profit back when the trend does eventually turn. And so I think that my systems can accomplish that. They can't accomplish making money all the time or when I want to, or maybe even in 2018. But knowing what I want to accomplish and having my system set up to do that, and defining success or failure in those terms. But certainly the most important thing that I've realized over the years, that in order for me to be successful and which is going to mean following the systems, it really, a lot of it for me depends upon trading with moderate leverage and not getting myself into situations where the losses and the drawdowns were too much, and it was mostly due to just trading too large, trying to make too much money. And So I think that's very important. Some of the issues that I have and I've experienced, when I looked into them very closely, it was just a function of too much leverage. No amount of money management or no amount of improving my systems would help when you trade too large.
Yeah, I think those are great points. Anything you've found over the years, Moritz, that works particularly well for you?
Yeah, just the experience, really. I mean, if 2018 were my first year trading, I'd probably be an emotional wreck by now. The reason I'm not is because we've been through that. And like Jerry said, you have to have the right leverage to your portfolio. And also what I recommend people do is, I mean, this is the great advantage of, that only we have because we're systematic traders and we can backtest our strategies, is to not just backtest the strategy and look at the historical P&L curve and the portfolio growth, but try to live that P&L curve. Go back to the beginning and, kind of like zoom in on periods that have been volatile and that looked difficult. Because, when you look at a 20, 30-year chart, those periods, 10 years back, 15 years back, 20 years back, you don't visually even see them anymore. I mean, they've become so small, they're so far away, maybe you don't even want to look at them anymore because you think, well, that's 20 years ago, that's information that's not valuable today. I disagree with that. I'd say go back to those periods and find those pockets where you've had many losing days in a row, losing months in a row, losing weeks in a row. Zoom in on those and try to relive those periods. Certainly, maybe that's not helpful to everyone, but it certainly was very helpful to me because it puts you into that state where you kind of like you have to understand that there were periods, multi-month periods, where things were just extremely rocky, and you had to go through those, and obviously not changing your system because, well, your backtest at that point is fixed, right? Without changing your system, but you will come out at the end of the day on top of that. And that helps me to be in the current period, with that experience, knowing that, well, that's part of the game. That pain is part of the gain that I'm going to have in the future. So let's just take a deep breath and become relaxed about it. Of course, you can only be relaxed to a certain point in time, to a certain extent. If that portfolio goes down by 80%, take my word for it, I'm going to be everything but relaxed. I don't think it's going to get there. I'm probably going to pull the plug before, but as it stands right now, there's nothing really to freak out about too much.
No, I think that those are great points, right? Because as you mentioned, the experience it takes to go through these periods and then come out of them, you can't replicate that from doing a back test where you say, oh yeah, those 5 months were a bit tough, but so what? I mean, those 5 months would have been very long and would have felt exactly as tough as this period has been in 2018. And so until you've tried it, maybe not just once, but a few times, with real money and real clients at the end of the line and so on and so forth, it will be it will have somewhat of an emotional impact. But as you work yourself through it, as you think back, as you rightly say, Moritz, think back how it felt and then how it also felt coming out of it, which is why I'm sure we will refer back to these conversations, at some point and say, well, that was a really tough period, and we now have documented how we approached and dealt with these periods. So good, yeah.
And maybe another, like, this is just a small trick, or maybe not even a trick at all, but I don't want to look at dollar P&L every day. Every once in a while, sure, I want to know how much money I've made or lost, right, in absolute dollar or euro terms. But to disassociate the process from the monetary outcome on a daily basis, and rather look at percentage returns, that helps me at least to stay calmer in periods of drawdown. It's like lost 1%, lost 1.5%, maybe we lost 2%, you're in a drawdown of 8%. Although, those are numbers that I think are emotionally much easier to take for your brain, for your psyche, rather than saying I'm, down that many dollars. And because if you say that, you're down that many dollars, you kind of like, as a human being, you equate that to being down a car or being down 2 cars or Ferrari. I don't know what, whatever it is, but then it becomes more hurtful.
I like that. That making the bottom line. Did I follow the system? I mean, I think that's where you want to be. As much as you can be there, you do have other responsibilities, and losing money and percentages and dollars and euros is, that's reality. You can't get out of reality, but grade yourself on how did I follow the system. I was in front of a client, a very, very large client once, and they asked me to talk about performance for the year. And I think one of the questions they asked was, well, how did you handle losses? And I'm like, A plus on losses.
That's great.
I got out of the losses every single time. I took a small loss every single time. And they're like, no, that's not what I meant. And of course I knew exactly what they meant, but I'm going to drag them into my world, the right world of following the system, entry, exit, stop loss, and doing every single trade. And that is the bottom line. I did all of the trades that I was supposed to do. I didn't trade too large. If I got into a situation where even with not trading too large, my drawdown was getting uncomfortable. I had a predetermined strategy of reducing leverage again, reducing positions and the size of future trades to make the possible drawdowns less likely in the future. And so this is a strategy that is just a huge winner because it allows you to continue to do the trades. And I've lived through many, unfortunately, bad periods, and most of the reason it was bad was because of me. And I did not have that as the bottom line, do the next trade. Because the way to get out of these situations, these drawdowns and losing periods, is the same way you got into them, which is do the trades. And I remember just marveling at certain traders that I just admired because they came right out. I mean, just stared down a drawdown by doing nothing other than the trade. And that's how you get out of it. Continue to do that same trade that got you into it. May have to do it smaller, but that's the only solution.
Yeah, love it. Absolutely. And it's, so true. So true. Next question, which is a question I'm going to kind of not comment on too much. It's from Brian, and I did reply to you, Brian, but I want to bring it up anyways, because it relates to a point that we talked about before, but it's hard to comment on something because it requires all of us to listen to a particular podcast before coming on. It's not a written question per se, but it is a podcast where one of the guests, Bob Farrell, makes a comment about breakouts, and they don't necessarily behave as they did in the past. But it's very hard, Brian, for Moritz and Jerry to kind of comment on that without really having to listen to the full podcast and put it in some kind of context. But clearly, depending on what time frame you look at, it's very easy to make that judgment or get that impression that breakouts are different. And I think the truth is the market continues to evolve, and they're not they're not static, so that you can easily have a period where breakouts can feel different and they may not work so well as we've seen this year, but it doesn't mean that they won't work as well in the future. It just means that right now we're in one of those periods where maybe breakouts don't work as so well for whatever reason, whether it's there are more participants, whether there are some other algos now, as we heard the renowned Stanley Druckenmiller say on an interview on Real Vision, where he was saying from his point of view, actually these algos, and not referring to trend followers for sure, but algos designed to basically force the price back to their mean once they try to move away and once they try to break out, these algos will come in and go against those breakouts. And maybe that's exactly what Bob Farrell is referring to as well. And that could well be the case, but it doesn't change that for long-term trend followers, there will still be opportunities to profit from these sustained trends, at least in my view, and I'm sure that's shared by both Moritz and Jerry. So I'm going to jump to the next point, which is actually, fun enough, something that relates a little bit. It's from Francois, and he has asked questions before, so we appreciate that, and we appreciate anyone who is willing to bring us a question. Just email them to info@toptradersunplugged.com, and we will do our very best to answer those for you. And Francois was just saying whether we wanted to share which conferences we were planning to attend next year, so that if people were listening to it and were at the same conference, they would have a chance to run into us and say hi. So I'm very happy to kick that off, Francois. And as I mentioned just before, Miami is a big center of conferences in the early part of the year. So Context and MFA is certainly conferences that I will be attending. And the only other one that I have planned to attend will then be the following Context conference, which is in Barcelona, in Spain, in May, I believe. Those are the things that I have so far planned on my side. I don't know if you, Moritz, and Jerry, whether you already have some plans laid out as to what events you may be turning up to.
Only for Context at the end
Miami.
of January.
Yeah.
Yeah, same here, Miami.
Well, there we have it. So maybe we will do something in Miami together where we could have a chance to say hi to some of you if you're going to be there. Well, anyways, to Francois, Brian, and Vincent, thanks so much for this week's questions. We really do appreciate those. Let me just run through the performance numbers as of Thursday before we see if there's any other articles or news or topics we want to talk about before we wrap up. But the month has started, on a quiet note, a little bit of a mixed note. And of course, it's only a week old. And these numbers are, as usual, they're as of Thursday, which is not the full week. I know Friday was probably, I have a feeling, not the greatest day for trend followers. So just take that into account. Anyway, the BTOP 50 index was down 47 basis points for the month so far, down 5.53% for the year. SocGen CTA index pretty flat for December so far, down 7.18 for the year. SocGen trend down about 36 basis points so far, down 9.29 for the year as of Thursday. And the short-term traders index was up 0.93%, but down 0.61% for the year so far. And the bridge alternatives index was up just shy of 1% as of Thursday, but down 10.32% year to date. Yeah. What else do we want to touch upon this week before we wrap up? Oh, by the way, maybe we should ask a question to our listeners if they want to comment on it. But we were debating between the three of us whether we should sometimes invite a fourth person, a guest, to join our conversation. So it would be interesting to hear what your thoughts are. If you want to tweet or send us an email, and of course, if you know some really interesting people that would fit well to our little group here, then we will be open to those suggestions as well. But tell us what you think. We love your feedback. So just tweet it to one of us or send it to info@toptradersunplugged.com. Jerry, Moritz, what else do we want to touch upon as we wrap up this first week of December? It doesn't look like the markets are quieting down as they normally do in this holiday month. Anything that's you're going to be focusing on or you want to talk about before we finish?
Yeah, I'll remember Jerry's being an A+ on the losses. That's important for next week. And other than that, happy trading.
Happy trading. The hashtag happy trading. Yeah. What about you, Jerry?
I don't feel too motivated to say anything that great right now. So I'm going to stick with the systems and head down and work hard, ignoring everything except the systems, I guess.
Great stuff. Well, as always, we're going to be wrapping up, but we're going to thanking you for being with us and listening to them. We really do enjoy making these episodes for you. So hope to be back with you next week when the next one comes out. And as usual, I will always remind you and ask you kindly to perhaps spend a few minutes leaving a honest rating and review in iTunes so that more people can discover our weekly conversations. From Jerry, Moritz, and me, thanks so much for listening, and we very much look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.